Hi, everybody. It's our second to last week. Next week, we're not meeting because you have a test to do and you have to make up any assignments that you're missing. But today's our last meeting. I'm going to go ahead and start us off with our PowerPoints for today. We're looking at chapter 20. Chapter 20 is all about the emerging economies. Can you believe it? We've just plugged along and we've gone through 20 chapters already. And this is our 20th chapter this week. This is the last one in your book. That's nice. It means progress, my friends, progress. You know? International business. Financial management, international business. What is financial management? Financial management involves investment decisions, what to finance, financing decisions, how finance those decisions, money management decisions, how to manage the firm's financial resources. Particularly, good financial management can create a competitive advantage, reduce the cost of creating value, adds value by improving customer service. Decisions are more complex in international business. Different currencies, tax regimens, regulations on capital flow, economic and political risk, etc. How do managers make investment decisions? Financial managers must quantify the benefits, costs, risk associated with the investments in foreign country. To do this, managers use capital budgeting. Involves estimating cash flow associated with the project over time, then discontinuing them to determine their net present value. If a net present value of a discounted cash flow is greater than zero, the firm should go ahead with the project. Why is capital budgeting more difficult for international firms? Capital budgeting is complicated in international business because a distinction must be made between the cash flows in a project and cash flows in a parent company. Because of political economic risk, because of connection between cash flows to the parent and the source of financing must be recognized. What's the difference between a project and a parent cash flows? Cash flows to a project and cash flows to a parent company can be quite different. Parent companies are interested in the cash flows they will receive, not the cash flows the project generates. Received cash flows are the bias for dividends, other investments, repayments, and debt, and so on. Cash flows in the parent may be lower because of the host country limits on the purchaser of profits, host country, local investment requirements, etc. How does political risk influence investment decisions? Political risk, the likelihood that political forces will cause drastic changes in the country's business environment that hurt the product, the profit, and other goals of a business. Higher in countries with social unrest or disorder or where the nature of society increases the chance of social unrest. Political change can result in the expiration of a firm's assets and complete economic collapse that renders a firm's asset worthless. Economic risk, the likelihood that economic mismanagement will cause drastic changes in the country's business environment that hurt the profit and other goals of business. The biggest economic risk in inflation projected in falling currency values and lower project cash flows. Firms analyzing foreign investment opportunities can adjust for the risk by raising the discount rate in countries where political and economic risk is high, by lowering future cash flows estimates to account for the adverse political or economic changes that can occur in the future. Firms must consider these two factors. How do foreign investment be financed? The cost of capital is usually the lowest in the global capital market, but some investments require local debt or equity financing. Firms anticipate the depreciation of local currency, may prefer local debt financing. How financial structure, debt versus equity of the foreign affiliate should be configured. need to decide whether to adopt local capital structure norms or maintain the structure used in the home country. Most experts suggest that firms adopt the structure may minimize the cost of capital, whatever that may be. Money management decisions attempt to manage the global cash resources effectively. Firms need to minimize cash balances, need cash balances on hand for notes payable and unexpected demands. Cash revenues are usually invested in money market accounts that offer low rates of interest. When firms invest in money market accounts, they have limited liquidity but low interest rates. They have interest in the long-term investments. They have higher interest rates but low liquidity. They reduce transaction cost. The cost exchange. Every time a firm changes cash to one currency to another, they face transaction costs. Most banks are in charge of a transfer fee for moving cash from one location to another. Multilateral netting can reduce the number of transactions between subsidiaries and the number of transaction costs. Every country has its own tax policies. Most countries feel they have a right to tax the foreign earned income of companies based on the country. Double taxation income of a foreign subsidiary is taxed by the host government and by host country government. How can firms limit their tax liability? Taxes can be minimized through tax credits. Allow the firm to reduce the taxes paid to the home government by the amount of taxes paid to the foreign government. Tax treaties, agreements specifying what items of the income will be taxed by authorities of the country where the income is earned. Differential principle specifies parent companies are not taxed on foreign source income until they are actually receive a dividend. Tax havens, countries with very low or no income tax. Firms would avoid income taxes by establishing a wholly owned, not operating subsidiary in the country. How do corporate tax rates compare? We can show right here countries like Canada, Chile, China, France, Germany, Ireland, Japan, Mexico, Singapore, United Kingdom, and United States. How do firms move money across borders? Firms can transfer liquid funds across border via dividend remittances, royalty payments and fees, transfer prices, fronting loans. Firms can use more than one of these techniques. Is called unbundling. Paying dividends is the most common method of transferring funds from subsidiaries to parent. The relative attractiveness of paying dividends varies according to tax regulations. High tax rates make less attractive. Foreign exchange rates, dividends might spend up risky countries. The age of subsidiaries, older subsidiaries remit higher proportion of earnings in dividends. The extent of local liquidity, participation, local owners' demands for dividends to come into play. What are the royalty payments and fees? Royalties are the ramifications. The ramifications paid to the owners of technology, patents, or trade names for the use of that technology and the right to manufacture or sell products under those patents or trade names can be levied as a fixed amount per unit as a percentage of gross revenues. Most parent companies charge subsidiary royalties for technology, patents, and trade names transferred to them. A fee is a compensation for professional services or expertise supplied to a subsidiary by a parent company or other subsidiary. Royalties and fees are often tax-deductible loyalty. Transfer prices. What are the transfer prices? Transfer prices is a price at which goods and services can be transferred between entities within a firm. Transfer prices can be manipulated to reduce tax liabilities by shifting earnings from high tax countries to low tax countries. Move funds from out of country where significant currency devaluation is expected. Move funds from subsidiary to the parent when dividends are restricted by the host government. Reduce import duties when ad valorem tariffs are in effect. What makes transfer prices attractive? But using transfer pricing can be problematic because governments think they're being cheated out of a legitimate income. Governments believe firms are breaking the spirit of the law when transfer prices are used to circumvent the restrictions of capital flows. It complicates management incentives and performance evaluation. Fronting loans. Loans are between parent and subsidiary channeled through a financial intermediary, usually a large international bank. Firms use fronting loans to convert the host country restrictions on remittance of funds from a foreign subsidiary to a parent company to gain tax advantages. What are fronting loans? An example of tax-expected fronting loan. Deposit 1 million, tax haven subsidiary, pays about 8% interest rate, tax-free. We have London Bank, a loan is about 1 million, pays about 9 interest tax deductible. How do firms manage global cash resources? Firms manage their global cash resources by using centralized depositories. Holding cash balances at centralized depository is attractive because by pooling cash resources centrally, firms can deposit larger amounts and therefore earn higher rates of interest. When centralized depositories are located in major financial centers, the firm can assess the greater variety of investment opportunities than subsidiaries have. By pooling cash reserves, firms can reduce the total size of the availability accessible cash pool and invest larger amounts of long-term, less liquid accounts to higher interest rates. But centralized depositories can be unattractive because of the government restrictions on cross-border capital flows, the transaction costs involved in moving money in and out. The use of centralized depositories is expected to increase because of globalization of capital markets and removal of barrier of the free flow of capital across borders. Multilateral netting can reduce the transaction cost associated with many transactions between subsidiaries. An extension of the bilateral netting. If a French subsidiary owes a Mexican subsidiary 6 million, a Mexican subsidiary simultaneously owes a French subsidiary 4 million, a bilateral statement will be made with a single statement of 2 million. Under multilateral netting, the concept is extended to multiple subsidiaries within an international business. Cash flows before multilateral netting. Korean subsidiaries, Japanese subsidiaries, Chinese subsidiaries, Taiwanese, you can see how they're all connected. We have Korean, Chinese, Japanese, Taiwanese, and the total payments showing the connection between the paying subsidiaries of Germany, France, Spain, Italy. Cash flows after multinational netting, showing you how the graph changes a little bit. Which of the following is not one of the decision areas of financial management? What do you think? Is it A, cash operations demonstrations, B, investment decisions, or C, financing decisions, or D, money management? Sorry, it's pop up. Okay, the fee for moving cash from one location is called what? Money management fee, transaction fee, transfer fee, or cost of capital. Compared to other countries, corporate income rates in blank are relatively low. And blank, it specifies parent companies are not taxed on foreign source of income until they are actually received a dividend. Firms can transfer liquid funds across borders. The following techniques except what? Dividend remittances, royalty payments and fees, transfer prices, or banking loans. Most common method of transferring funds to parent is through dividend remittances, royalty payments and fees, transfer prices, and banking loans. Right, nice job. Let's look at this one. This is challenges. Challenges in multinational sales and marketing. When we're looking at international sales and marketing, we have been talking about that this whole quarter. Definitions of international sales and marketing, the performance of business activities designed to plan, price, promote, direct the company's flow of goods and services to consumers or users in more than one nation for profit, the 4 Ps. What's the difference between marketing domestically and internationally? Marketing concepts are universal, the goal to make profit. Differences in international marketing all have environments that are taken into consideration when all the marketing plan is developed and executed. Must consider legal environment, governmental controls, climate, weather, cultural beliefs, and buyer behavior. Uncontrollable elements, of course. And why is international marketing so important? Companies can no longer ignore the effects of international marketing. Competition no longer exists, just the domestic companies. In order to sustain profitability and growth margins of the past, companies have to look for alternative methods of marketing for products and services. In a study conducted by U.S. manufacturing companies of all sizes, it was found that multinational companies outperformed their strictly domestic U.S. counterparts by more than twice as fast as the sales and earned as much as the returns on the equity and assets. International sales and marketing tasks. The task, the marketing plan, controllable, price, promotion, product, place, distribution, domestic environment, uncontrollable, political, legal, competition, and economy. Foreign environment, uncontrollable, structure of distribution, geography and infrastructure, cultural, political, legal, economy, competition, and level of technology. Oops, we have a commercial. The importance of uncontrollable elements. In order to succeed internationally, a company must understand the impact of uncontrollable elements to make up the country's culture. Cultural understanding is like iceberg. We're not aware of 9/10 of it. In order to be successful in adapting to the international markets, the market plan needs to be incorporate strategies to anticipate as much as the uncontrollable factors that influence both the foreign and domestic markets and allow for maximum flexibility to adjust for future changes. Obstacles to success in the international marketing. The SRC, self-reliance criterion, ethnocentrism, using one's culture, values, and experiences as the basis for decision in international situations. By reacting to situations in this manner, cultural differences are ignored. Behavior might be offensive. The less egocentric the business is, the greater success it will have marketing its products and services. To be globally aware, a company must have the following: objectivity, tolerance to cultural differences, knowledge of culture, history, world market potential, and global economic, social, and political trends. Stages of international marketing involvement. No direct foreign marketing. A company does not actively pursue customers in the foreign markets, but receives them through unintended channels. Products are brought abroad through domestic wholesalers, distributors, websites, on the internet, and frequent foreign marketing. Companies sells to foreign markets only when a temporary surplus of product exists. Once surplus is gone, foreign activity is gone. Few companies fit this model because of the need to develop long-term relationships in foreign countries. Then we have regular foreign marketing. Companies produce their products and services to primarily sell domestically, but also internationally through domestic foreign middlemen, sales force in foreign countries. International marketing. Companies are fully engaged in international marketing strategies. Companies are now international or multinational. Global marketing importance. Change from the marketing activities to all activities focused on global perspective. Treat the world as one market. market segment is no longer focused on national borders. Rather, such things as income levels, usage patterns, and other factors looked across borders. Domestic market extension orientation. International markets are secondary to the domestic markets. Multi-domestic market orientation. Each country has specific and separate marketing plan to address the differences. Global marketing orientation. Marketing activities are global, strives for efficiencies to scale through standardization. Export documentation is complex in nature as the number of documents is to be filled in very large, so also is the number of concerned authorities to whom relevant documents to be submitted. It is therefore advisable to take the help of shipping and forwarding agents who will obtain and fill out the documents correctly, as well as arrange for transportation. There are buyers and exporters, buying agents, RBI, authorized dealers where exporter and the bank port authorities, VAT and exercise authorities, insurance companies, inspection agencies, clearing and forwarding agents, shipping companies, and airline and inland carriers, etc. Export documents can be classified in the following 4 categories. Commercial documents, regulatory documents, export assistance documents, exports required in importing countries. Commercial documents, these documents are used by exporter importers to discharge their respective legal and other incidental responsibilities under a sales contract. Commercial documents can be further subdivided into principal commercial documents, auxiliary commercial documents, principal commercial documents. These documents serve the following purposes: to effect physical transfer of goods and title of the goods from the exporter to the buyer, to realize export sales procedures. Principal document include commercial invoice, the invoice prescribed by the importer, packing list, certificate inspection, certificate insurance policy, bill of landing, airway bill, combined transport document, certificate of origin, bill exchange and shipment advice. Regulatory documents. These are prescribed by various government department bodies in compliance for formalities under relevant laws governing the export transactions. These include Exchange Control Declaration Form, GR Form, Freight Payment Certificate, Insurance Premium Payment Certificate, R, I and R2 form, Shipping Bill, Bill to Export, Court Trust Copying of Shipping Bill, Court Trust Copy of Shipping Bill, Export Application, Doc Chaplain, Receipt of Payment of Port Exchanges, Vehicle Ticket. Export assistance documents. These are documents which are required for claiming assistance under various export assistance, measured as their operation from the time. Currently, these refer to drawbacks from central exercise and customs duties, packing credit facilities, etc. Documentation requires by importing countries. These are documents which are required by the importer in order to satisfy the requirements of the government. These include certificates of origin, consular invoice, quality control certificate, etc. All right, let's go ahead and take a 10-minute break. Okay, break time. Okay, welcome back, everybody. We're talking about the emerging markets. This was written by Mohammed and YouTube. So, definition of emerging markets. The list of 25 multinationals, characteristics of BRIC economies, table showing developed and emerging markets. We have BRIC countries, non BRIC countries, and challenges. According to Chinua University Iowa Center for International Finance and Development, the emerging markets are countries that are reconstructing the economies along with market-oriented lines, and they offer wealth of opportunities in trade, technology transfers, foreign direct investment. The term emerging markets was coined by Antoinette Van, dates back to 1981. Emerging market economies, BRC, economies of Brazil, Russia, India, and China. Goldman Sachs. By 2050, the combined economies of the BRICs would eclipse the combined economies of the current enriched countries of the world. These countries encompass about 25% of the world's land coverage, 40% of the world's population, and hold a combined GDP, $15,434 trillion. These four countries are among the biggest and fastest growing emerging markets. The definition emerging market, top 25 multinationals, characteristics of the BRIC countries, table showing developed and emerging markets, BRIC countries, non-BRIC countries, and challenges. Here's top 25 class emerging multinationals. We have characteristics of the economies. Some of the key characteristics of the BRIC economies are, firstly, they are regional economic powerhouses with large populations, large resource bases, and large markets. Their economy success spurred development in countries around them, but they experience economic crisis. They can bring their neighborhoods down with them. Secondly, there are transactional societies that are undertaking domestic economic and political reform. Thirdly, there are the world's fastest growing economies, contributing to a great deal of the world's explosive growth trade. By 2020, the biggest emerging markets share the world output will double to 16.1 from 7.8 in 1992. They will become more sufficient buyers of goods and services than industrialized countries. Fourth, they are critical participants in the world's major political, economic, and social affairs. They're seeking a larger voice for the international politics and bigger slice of the global economic pie. We're looking at developing countries, 26 here, Australia, Austria, Belgium, Canada, Denmark, Finland, France, Germany, Greece, Hong Kong, Ireland, Israel, Italy, Japan, Luxembourg, Netherlands, New Zealand, Norway, Portugal, Singapore, South Korea, Spain, Sweden, Switzerland, United States, and United Kingdom, United States. Emerging markets, 45, Brazil, Hungary, Mexico, Poland, South Africa, and Taiwan. Then you have Argentina, Chile, China, Colombia, Czech Republic, Egypt, India, Indonesia, Malaysia, Morocco, Pakistan, Peru, Philippines, Russia, Thailand, and Turkey. Now you got some more. Bangladesh, Botswana, Bulgaria, Croatia, Cyprus, Estonia, Cote d'Ivoire, Jordan, Kenya, Lithuania, Republic of Macedonia, Madras, Nigeria, Oman, Qatar, Romania, Serbia, Slovakia, Slovenia, Sri Lanka, Tanzania, and Vietnam. The BRIC countries, Brazil, Russia, India, and China. We have Brazil data, the largest and most populous country in South America, fifth largest country by geographic area, fifth most populous country in the world, fourth most populous democracy in the world. Moderate free trade, free market, and export oriented economy. No, per capita, GDP surpassed US 10,500 in 2008 due to the strong and continued appreciation of the real for first time in the decade. 10th largest economy in the world to second largest in Americans measured by purchasing power parity in the Americas after United States. Attracted 248.9 billion worth of the FDI, 16th biggest recipient of FDI ahead of countries like Japan and South Korea. Agriculture is 5.5, industry is 28.7, and services is 65.8. Agriculture and commodities. In the foreign markets, it answers about 25% of global exports of the raw cane and refined sugar. It's the world's leader in soybean exports and responsible for 80% of the planet's orange juice. A pioneer leader of manufacture, short fiber timber, cellulose. Brazil also achieved positive results within the packaging sector, which is the fifth largest world producer. Brazil accounts for about 3/5 of the South American's economy and industrial production. Accounting for 1/3 of GDP, Brazil's diverse industries range from automobile, steel, petrochemicals, computers, aircraft, consumer durables. Top companies among these diversified industries are Embracer and Aracruz Cellulose. We have industry, service sector. Brazil is diverse and sophisticated services industry as well. During the early 1900s, the banking sector accounted for as much as 16% of GDP. Top performers in the sectors are Banco Bradesco and Banco de Brazil. We have another one, company top Brazilian firms, Embracer, headquartered in Sao Paulo, Brazil. Embracer is a Brazilian aerospace conglomerate. The company produces commercial, military, and corporate aircraft, as well as providing related aerospace services. It also has maintenance and commercial sites in the U.S. and commercial offices in France, Singapore, and China. Recently replaced Canada-based Bombardier, became third largest producer in aircrafts. As of July 8, 2008, Embracer had workforce for 23,885 people, and the firm is ordering backlog totaling about US $20.7 billion. The key products are: it is delivered more than 1,000 aircrafts. 2003, Embracer entered a partnership with the Harbour Aircraft Manufacturing Corporation and Harbour Tornado produced ERJ 145 for the Chinese market. Some of the key customers are Air Forces of Brazil and Colombia. We have revenue and region, Europe, Brazil, North America, others in Latin America. We have Petrobras. It's a semi-public Brazilian energy company headquartered in Rio de Janeiro, founded in 1953. It's ranked 81 by Forbes Global List of 2000, biannual ranking of the top 2,000 public companies in the world by Forbes magazine. It's a significant oil producer with output of 2 million barrels of oil equivalent per day, as well as major distributors of oil products. It opened the world's largest oil platform, the Petrobras 36 oil platform, until the explosion on March 15, 2001, that led to the sinking of the March 20, 2001. Petrobras is the world leader in development of advanced technology from deep water and ultra-water oil production. Petrobras works extensively with foreign acquisitions too, buying and controlling the most important energy companies in South America, and exploring a huge deep water fields of West Africa and the Gulf of Mexico. Is a major Brazilian manufacturer a pulp, It's headquartered in Sao Paulo. The company is the world's leading supplier of bleached eucalyptus pulp. Its early revenue of 2007 was US 2.79 billion 2007. Is a diversified mining multinational corporation and one of the largest logistics operators in Brazil. In addition to being the second largest mining company in the world, it's also the largest producer of iron ore pellets and the second largest of nickel. In the electrical energy sector, the company participates in Castorda and currently operates 9 hydraulic plants. Val managed to establish itself in the global mining company through joint ventures and acquisitions abroad. Val participation in mining operations in Finland, Canada, Australia, Mongolia, China, India, Angola, South Africa, Chile, Peru, and other countries. Now we're looking at Russia. Russia is the 10th biggest economy. Currency, Russian ruble. GDP is 2.26 trillion. GDP per capita is 14,600. GDP by sector, agriculture is 4.6, industry is 39.1, services about 56.3, and inflation is about 11.9. Here's the exports, country distribution. Do I need some more? Then we have 1998 Russia financial crisis, 2002 boom in capital investments, oil and gas dominate Russia. Exports heavily depend on the price of energy. Here we have aggregate fixed capital investment grew by 21.2% at the 9M in 2007 from 11.8% growth the same year of 2006. We have oil and gas, power, engineering, financial services, automotive, transport, information, community technology. Constructive, creative industries, healthcare, biotechnology, pharmaceuticals, food and drink, sport and leisure, infrastructure. World's second largest producing country. With up to 14% of the world proved oil and reserves, 46% of the world reserves. Growth requires development of major deposits in inaccessible regions of the Arctic zone. Would need be the world's largest technologies, equipment, engineering. 2006 growth in manufacturing industry is about 4.8, with some engineering companies reporting annual growth of 14%. Need to upgrade or replace old production equipment and technologies. Looking for suppliers of relevant equipment as they believe that foreign equipment and technologies are advanced and reliable. The ITC is fastest growing sectors in Russian economy. Annual growth is about 20 to 25%. Russian mobile telecommunications is the third largest in the world. One of the most dynamic industries in the world is the automobile. 2006, the fifth largest passenger car selling in Europe. Airports, growth in air traffic numbers. 360 airports needed reconstruction and investment. Railway, second largest railroad network, 100% state owned. Growth is likely to remain robust, with energy prices set to remain high. Booming domestic demand will continue to translate into strong growth in services and manufacturing, lowest PEs in the global emerging market arena, marketable degree of the economic stability over 5 years. We have India, second fastest growing economy, second most populous country, fourth largest economy in purchasing power, world's 12th largest economy at market exchange rates, has populist democracy in the world. Before 1991, semi-socialist approach, strict government control over private sector participation, and foreign trade and foreign direct investment. Since 1991, India has gradually opened up the markets through economic reforms and reduce government control on foreign trade and investment, privatization of public-owned companies, and opening of certain sectors to private and foreign participations continued amid political debate. Average GDP growth is about 5.7 in the past 2 decades. Automobile, information technology, pharmaceuticals, and biotechnology. 10th largest sector in the world with annual production of approximately 2 million units. A number of domestic companies produce automobiles in India, and growing presence of multinational investment too led to the increase of overall growth. Size of the market, structure of the market, major domestic and international players, opportunities for growth potential. The U.S. 34 million industry exports constitute about 5% of revenues. 11 million vehicles produced in India in 2006 to 2007. However, India still has a low vehicle penetration. Only 3 cars, 52 wheelers, about 100,000 or 1,000 individuals. Structure of the market. The market has a mix of large domestic private players like Tata Motors, Mahara, Ashwell Leyland, Bahara Auto, Hero Honda, and major international players including Suzuki, GM, Ford, Daimler, Toyota, Honda, Hyundai, Renault, VW, and Volvo. All the major international players have set up manufacturing capabilities in India. Here's some companies in India. The advantage for investing is low cost, high skilled manpower with abundance of the energy talent, the second largest in the world. Established automobile testing, R&D centers, among the lowest cost producers still in the world. Opportunities to address in the global auto market while leveraging domestic market. Size of the market, structure of the market, major ITs and ITs companies, opportunities. Size of the market, India's leading destination for providing IT and IT-enabled services. ITS revenues is about US 40 billion, 2006 to 7. Experts constituted 79 of the total ITs and ITES's revenues. We have IT services and software, ITES, and domestic market. The industry has 3 broad characters of companies: Indian IT and ITS. Companies ranging from large companies, Tata Consultancy Services, Infirst, Wipro, HCL, to small niche companies. Global IT companies such as IBM, Dell, Microsoft, HP, Accenture, etc., all with whom have set up development centers in India. Capable back operations of the large global corporations like JP Morgan, American Express, JE, HSBC, and British Airways, etc. Here's major IT and ITS companies in India. India's inherent IT capabilities, talented workforce, world-class companies, availability of technological skills and English-speaking labor force a fraction of the cost of the US and Europe. Quality orientation, project and process management expertise, international recognition, opportunities to supply the global market in addition to serving the growing domestic demand. And size of the market, and major IT, ITS companies, and opportunities. Indian pharmaceutical company is an example here. It is about US 13 billion, 2006 to 7 revenues. India occupies a significant position of the world's pharmacy market by 8% by volume, the 4th largest in the world, and 1% by value. The pharmacy industry exports about 6 billion, and it ranks about 17,000 in the terms of the export value. India accounts for global energetics market. There are some careers in the logistics. Here's some concepts about logistics, types of logistics, the situation of logistics industry in the past 3 years and current resource needs, the introduction of the IDF companies in Vietnam, and current trends and requirements for human resources after the age of oil. Here we have some examples of logistics: purchasing, storing, distributing, replacing people, replacing equipment, planning, applying, and controlling. We can see the factors here: right customer, right product, right time, right place, right condition, right quality, right cost. Role in logistics: increasing competitiveness, global logistics service networks, increase GDP, trade relationship among countries, and reduce transportation costs. Here's your role of logistics: expand market and international trade for the business, make good impression for large investors. Here we have classification logistics. We have self-sufficient logistic shippers, provide logistic services by themselves with their own facilities. Part of logistic owners hires, part of logistic services outsource logistics. Logistic service provided third party by single. Logistics chain fully provided logistics, logistics, e-commerce. The main group of logistic services, the transport group of logistic services, and the group related to logistics service. Loading goods from a container, unloading goods from a container. Warehouse services, transport agency services perform custom procedures, loading and unloading goods. Additional services could be like container leasing, buy and selling, check inventory, and HS Score and International. Reports online, situation logistics, infrastructure, logistics, service, environment, and business. 7 assets and manufacturing trading. Current situation, demand. Maybe more situations. In the next 3 years, we need about 8,000 employees. All right, so we're done for today. Thank you so much, everybody. And have a wonderful year. And don't forget to turn in your test next week. All right, bye, everybody.